After a record 2021, the M&A market has ebbed from its torrid pace as economic and geopolitical uncertainty flowed. Deal volume was historically strong in the first quarter before throttling down in the second quarter. But all in all, this is a very active deals market, and companies looking to drive their growth, transform their portfolio, and generate returns on their capital will be active. Second quarter announced value is on pace to be in the top 10 historically, and deal making is still near a high water mark. So setting aside 2021, we're focused not on whether volume is up or down, but how to get the right deals done well to drive strategic growth and capital returns. There's still an abundance of capital in the system for both corporate and private equity to fund deals. S&P 500 companies had $3.7 trillion of cash at the end of 2021. U.S. private equity has also nearly $1 trillion in dry powder, and SPACs remain a factor. Collectively, that capital has more opportunities for M&A investment as valuations moderate with market volatility. And as that volatility inhibits IPO volume, alternative sources of capital or transactions may be more likely, including with private equity. The increasing need for speed in business transformation provides another reason for deal-making optimism. Some of the same forces creating uncertainty in the market, the lingering pandemic, and geopolitical turmoil also are driving deal-making imperatives. Whether a company needs to transform its capabilities, supply chains, or go-to-market approach, the market is impatient, and one of the fastest ways to accelerate transformation is through M&A. Now let's hear from some of our sector leaders on what they are seeing.
As we look forward to the second half of 2022 and into 2023, we expect the deal market to continue to be robust, but thoughtful. There are a lot of resources and capital still to deploy. Corporations are looking for strategic areas to build out their products and platforms. This may be more in the form of tuck-in opportunities or smaller deals, given the regulatory concerns that many have had, and concern that large transformation deals may not get approval.
We have large balance sheets, large cash reserves. We have private equity coming in and looking to take out companies at valuations that are much lower than 12 months ago. We have strategic buyers coming in as well. So we expect to see that continue. So your fallen unicorns, your battered SPACs, and we'll continue to see activity within gaming, within content as well, within semi and software. We expect the mother lode of consolidation in M&A over the next 12 to 24 months within the TMT sector.
The reductions in valuations in the public markets are creating tremendous opportunity for private equity to take private some of these firms where they see long-term potential. In addition, most of these public companies faced with falling valuations are getting forced to think about spinning off non-core assets, which again creates tremendous opportunity for PE.
The deal value and volume for consumer markets is still very robust. Given the sector dynamics and the recovery of hospitality and leisure, we wouldn't be surprised to hear that most of the mega deals are happening in that subsector.